Hey everyone, Brian Bogner, Greg Towner here with Parallel Portfolios, and we're gonna take the next few minutes and talk to you about how we manage risk and volatility. Okay, why is this important? Well, it's March here, 2022. Markets are really volatile right now. Of course, Russia's invaded Ukraine. There's just a lot of geopolitical things going on, a lot of things happening, and it's been a while, to be quite honest with you, since we've had some of this volatility. So we think it's important to talk about how we manage through it. And look, we're going to go a little bit longer than we normally do in this video because we really want to get these points. But the reality is what we're going to be talking about today, while it's relevant today, it's going to be relevant a year from now, 5 years from now, 10 years from now. This is really, really important stuff. So let's go ahead and get started. I always like to start with a good quote. Of course, this is Warren Buffett, one of the greatest investors of all time. And what he says here is the thing to do is to keep your mind when the world around you is losing theirs, okay? And when it comes to volatility in the markets, this is so, so important, right? Because in volatility, usually it's going down, it creates pain, it creates negative emotion, it creates very hard things, and we want to react, right? And so we react to it, and a lot of times we don't make the best decisions. Now is the time we've really got to keep our mind. And how do we do that? We do that by having a process, okay, and sticking to that process. And that's exactly what we're going to be talking about here. So let's define what risk management is not, okay? First and foremost, it's not an attempt to pick tops and bottoms. I think a lot of people feel like, well, with that type of strategy, we can get out at the top and get into the bottoms. Absolutely not. Even the best of the best of the best who do it, it's usually some luck involved, and they can't repeat it, okay? Because it's very, very hard to do. All right. It's also not an all-in and all-out bet either. So we're not. This isn't a strategy where we move everything in and we go out and we're just going cash, fully invested either. It's not it. It's not a guarantee that your portfolio won't decline at times. Okay. We're invested in stocks. There will be periods of losses. Okay. But what is risk management? It's hopefully what we're shooting for here is a way to reduce those losses, okay, and lessen the portfolio volatility. We don't get completely out of the way, but we're going to try to reduce it as much as we can, okay? It also reduces the chance for us to make emotional decisions, because that's usually in the investing world when you do something that you're going to regret a very, very long time. But most importantly, it is the bedrock, the cornerstone of our entire investment process. As we go over these next 4 steps here, you will see that this risk management piece really is embedded in every single thing that we do. So I'm going to go ahead and turn it over to Greg. Greg, take us through the 4 risk management steps.
Okay, fantastic. Well, of course, as most of you probably know, our investment process starts with quality. We believe it's critical to screen for quality, particularly when we're talking about individual stocks, and for a couple of reasons. Historically, high quality has tended to outperform. Of course, we like that, but why does it do so? It can keep up on up markets at times, but for the most part, it really does great during times of volatility. So historically, it's 30 to 35% less volatile when you're in the high quality assets. So we love that because it keeps investors engaged, it keeps them investing. The last thing you want is for volatility to shake you out of the market at the worst possible time. And so quality helps keeps investors going, and it helps use risk management. Rules-based, we love following a disciplined plan. To some extent, it almost doesn't even matter what your process is, just that you have one that you can repeat and follow over time. I mean, the worst thing that you can do is just allow headlines to drive your decisions, or what happened to do well recently, or some stock tip that you heard. It's not something that you can repeat. It's not something that you can have any kind of risk management with. So you want to have a rules-based plan. And sometimes, Brian, you just kind of get back to the basics. Diversification, it can be easily ignored. If you don't have something in your portfolio that's causing you pain at any time, you're probably not diversified, because if everything moves together, that's kind of not diversification, right? So, a lot of investors found that out over the last year or two. They got too concentrated in tech or growth, and they found out they weren't diversified when it all went down. And it might be a different asset class next time. It's just that the diversification is very important and can often be overlooked. And we think this is a great example. This is a periodic return chart, goes back all the way to 2007. It covers most of the major asset classes by color here. You can see it's so hard, if not impossible, to predict what's going to happen this year and next year, and these asset classes bounce all around. But what you have is, if you follow that black line and those gray boxes, that's a mixture of these different asset classes. And you can see that it kind of bounces around in the middle here all of the time. So you get good, solid, healthy returns. But the last column on the far right is a measure of volatility over this entire period. You can see that mixture, that diversified mixture, is down near the low end for volatility. Again, emphasizing the importance of diversification. Now, if we talk about our 4 steps for risk management, we certainly have to talk about our stop loss strategy. For us, it's not actual physical stop losses, it's alerts that we receive at the end of the business day if something is closed below our particular alert level. It's not a given percentage. We can't say it's exactly 15% decline or something like that. It's in that range typically. But for us, we set that level before we enter a position. When it breaks a key trend or support level, that alerts us at that time. And so, for our core holdings, for most of our portfolios, about 3/4 of our positions, we consider core holdings. It's kind of our buy and hold type positions. If we get an alert on those, we may actually buy more on weakness. We get a new full fundamental review of that core holding. If nothing has changed fundamentally, hey, we might just add on weakness. But it's for the other quarter or so of the portfolio, the more tactical, the more explore side of things. That's where the stop loss really comes into effect. And we'll just sell out of that position when it hits. We'll either go to cash, we'll occasionally buy a new position with those proceeds. That's where the risk management, the stop loss side comes into effect. And so to us, it's really a good mix of the buy and hold with some tactical risk reduction. It kind of blends both worlds for us.
Excellent.
So we wanted to take a broader look at, of course, there's always volatility in the market. This looks back, I know this is a little bit hard to see, but basically this is going back to 1980, all the different times where we've had corrections. That's 10% or more corrections in the S&P 500. Usually about 1 or more a year sometimes. But really all you need to focus on here is the 2 columns on the right. Those are 1 and 2 year returns after the correction bottomed. And they were substantially higher than normal market returns. And you can see all the green. Even if you can't see the numbers, you see the green there, and that's good. And so, of course, none of us know when the corrections end. And that's kind of the point of the risk management, to stay mostly engaged in the market. So you don't panic and just say, oh, get me out, I'm going to go to all cash, because you're going to miss out on these returns when the market recovers. That's when the big returns are often made. You don't want to miss out on those.
Right. All right. So just some important things to remember as we kind of wrap this up is that losses cause the mental anguish twice as much of the joy of winning. Okay, and really this gets to you're more motivated by pain than you are by pleasure. Okay, and so when the market is selling, that need to want to do something is twice as strong as like when you're when the market's maybe making new highs and you're making money and things like that. So that's why you see a lot of people that will pull the trigger and sell usually at or near the low. Okay, so again, we get back into emotions, right? They don't help us when it comes to investing. Your ability as an investor to take risk and your willingness to take risk might differ. And usually what we tend to see a lot is your ability to take risks is actually a lot higher than your willingness. Okay, and so we're always trying to make sure that these two are in line with each other. You need to avoid the noise and do not combine like headlines and politics with your investing. Look, the headlines are really bad right now: inflation, supply chain issues, war. There's a lot of headlines right now that are just not good, but that does not always correlate to exactly with what the market's doing. And a lot of times we think that. I mean, look, I'll just be quite honest with you, and I'm not going to get political, but if I had $1 for every time I heard somebody tell me that if Biden gets elected, this is going back to the election, the market was going to tank. And guess what? The complete opposite happened. Now, again, I'm not trying to be political. I'm just trying to say, when we start to build these narratives of how we think things are going to happen, a lot of time they don't happen that way. And that's not necessarily what's driving the market there. Okay. By the time that you're comfortable with getting invested or with world events, usually the market has moved higher. And that's because the market is forward looking. And I have a lot of clients, they tell me this, they'll say, they'll say, you know, Brian, let's just wait. Let's wait till, you know, maybe the war in Ukraine settles down and the inflation comes down and this happens, and then I'll look to, you know, put some money to work. And when all that happens, the market's already made its move because it's looking forward. And typically it starts making that move when there's still a lot of doubt or people still aren't really thinking that, you know, things have solved itself yet. Okay, so but when you wait, you usually do miss out. But that being said, you know, surprises can always happen in both directions. So, you know, we just never know. Okay, that's why we do have this risk management, because we make these choices, but we don't know, because you can surprise the upside, you can surprise the downside just as much. But the key thing here, and we'll end on this, is that you need to focus on your long-term financial plan. Okay, we can sit here and say, you know, we can plan around investments, and that's important. But at the end of the day, what are you trying to do with your plan? What are you trying to accomplish? Are you still on track to reach your goals? Because even with the volatility, even with the downturn, if you're still on track to reach your goals, that is what is important. Okay, if you've not taken the time to define what your goals are and get that plan in place, give us a call. Okay, we'll help you do that. That's what we do for a living. But ultimately, that is what is the most important thing. Okay, so here's where you can find us. You know our number, you know our email address. Thank you so much for listening today, and we'll talk to you soon. Thanks.